All right, some stuff broke over the last 48 hours of trading. It obviously was a very rough start to this week. First, we got to dissect and kind of separate out some of the things that came together because, boy, a lot really did come together in a bearish way. It was like everything bearish everywhere all at once. There's a lot of folks, I think, that want to really pinpoint the causality of this to one thing, and it's just impossible to do. You can't just write this all off as saying, oh, the Bank of Japan does something different now, and so the yen carry trade blew up, and once we work through that, we'll be all right. That's my concern about being a little bit too broad with the brush, especially when it comes to the carry trade stuff around the yen, because keep in mind that wouldn't be as big of a deal if it weren't for the slowdown in the U.S. economy that's happening. At the core of this still is a growth scare, I believe. And on top of that, I also believe that there is a very real reckoning in the AI trade. We can't forget the way all this is coming together. So firstly, looking at VIX to give some perspective on other sell-offs. This is a really big sell-off. That tells us that it is more than just kind of a positioning thing. If you look at some of the bigger sell-offs over the past decade, this is VIX going back 10 years, okay? Firstly, let's look at 2018, the Vol-mageddon, VIX-explosion, when the VIX products, inverse volatility products all blew up. Today's move is way bigger, okay? This is a monster event that goes beyond just kind of a trade that went awry. Really, over the last couple of years, the only thing it compares to, of course, is our massive COVID event, which was an absolute growth destruction on a global scale. So to think that this is such a isolated sort of institutional trade that went wrong and we just got to work through that, that's not it, okay? This starts with the economy. It has been. We've been in trouble since the rotation started on July 10th. That was the market abandoning the AI trades in the growth in favor of this economic hope that the soft landing was going to go into this immaculate landing, which is what I called it at the time, which doesn't make sense based on the data. This is economic at its core. Remember, the Japanese yen carry trade wouldn't be so bad if the dollar weren't so soft. And the dollar's so soft because our economic data are missing. Jobs had a big miss, and now the Fed's going to be forced to cut. And why are they going to be forced to cut? Because there's late cycle behavior happening. What have I been talking about? What have people been ignoring? You can't just ignore the stuff that's been happening in bonds because it didn't happen at a quick enough timeline as some were predicting. Obviously, there were a bunch of early recession calls over the last year and a half, but once again, for like the third time in a week, when you look at the yield curve, there's the window here until October in which the recession still is likely to hit according to the yield curve analysis. So the whole trade that we had over the last couple weeks just didn't make sense. And so when that comes to reality and the economic data goes soft, then the market gets hit. There's a growth scare embedded into this that's at the core we cannot ignore. Because if you ignore that, then you might be tempted to go in and start buying dips and stuff like regional banks that ripped and whatnot. But that's where you're going to have to be very careful until the dust settles, until we see economic data improving, or maybe the Fed go hyper dovish. The cyclical stuff that was leading the last month is likely to be under pressure. But here's the catch, is that the tech stuff too is likely to still be under pressure because we keep finding out a bunch of negative news flow from the AI world. Apple's potential delay that was reported, Nvidia's Blackwell delay. You've got Alphabet losing its search antitrust suit. You've got now a whole litany of news flow telling us that the AI hype really got extended, even arguably for some of the core trades surrounding it. The fact that Apple and Microsoft, these consumer-facing businesses that were trading at extraordinary valuations, that makes buying the dip there tricky too. And so where then do you go? I think about stuff like the BTAL fund that I've talked about, anti-beta, things that do have short components and equities probably work. Now, when VIX has a huge pop like this, it's most likely to settle down. So going to buy downside protection also is kind of a risky move as well. But here's what I want to take away from this generally, is that it has been building for some time. Look at the way gold's been working. We've got evidence of stuff that does work. I don't even need to say it, do I? Obviously, Bitcoin doesn't work in this environment. It's a risk-off asset still. Crucially, BTC making lower lows and lower highs. More evidence that tells you that this stuff has been building here really for more than just a week. This wasn't just like some trader that got on the wrong side of the Japanese yen or even multiple of them. This is a macro event that's sourced in a growth concern. The red light goes on to Bitcoin because there's froth coming out of tech. It's not obvious where to go except for the stuff that's demonstrated real safety.